for a few more people to hop on. Okay, I think we're going to start. Hello everyone, my name is Howard Reisman and I'm the CEO of Stock Rover, and I'd like to thank you for joining us. With me to assist with the webinar is Alexander Reisman, the Communications Manager for Stock Rover. Today I'm going to do a webinar on using Stock Rover to help you plan your trades intelligently. So first, a couple of quick laundry list items. We've put everyone on mute to limit the background noise during the presentation. Secondly, we encourage questions. So feel free to type questions into your question box at any time during the presentation. We will answer all questions at the end of the webinar. To follow along with the presentation, there's an outline of what will be covered, and it's on the website. It's at stockrover.com. Let me show you where it is. So if you go to stockrover.com, the URL is webinar-outline.html, but there's an easier way to find it, which is if you just go to the home page and then click on the full webinar schedule, and then on the bottom you'll see click here for recordings and notes for past webinars, and click on that, and you'll see planning your trades intelligently. The notes are available both in Word and PDF format. So if you click on the download link, you can get the notes for this webinar, and you can look at them or save them. So planning your trades intelligently. Where do you begin? There's a tool in Stock Rover called portfolio modeling, and it can act as a very powerful assistant in helping you plan your trades. It will show you the consequences of trades that you're contemplating across a number of different dimensions, such as the cash consumed or freed by your trades, changes in sector balance, and changes in your risk profile. The portfolio modeling tool is not the easiest thing to find in Stock Rover, but once you find it, we think you'll be glad that you did. In the next rev of Stock Rover, we're going to redo the UI a bit, so the key tools such as portfolio modeling along with portfolio analysis are together and a bit easier to find. But let me show you where it is now. So if you have the Stock Rover app open and you go to the nav panel and you select any of your portfolios, you can right click on them, and the fourth item down is model, and if you click at that it will open up the modeling screen, the modeling facility. So the good news for portfolio modeling is that it's available to both basic and premium users. There are two differences between modeling for basic and premium users. The first is that Stock Rover does not store the model across sessions for basic users. So as you may change quantities, which you would do here, the sequence for basic users would be to do all your changes and then export them to an Excel spreadsheet so you would have them in one session. Excuse me. For premium users, the changes are stored across sessions. The second difference is that premium users can detach the modeling panel and open it in a separate window, independent window, by clicking on this. For basic users, it will render as it does here over the current app. So one thing to note, next month, actually through October 20th, we've enabled storage of the modeling facility for basic users, so that if you do model over the next month, we will store it across sessions, so you can experience kind of the full modeling feature in that regard. And as a side note, we've also enabled all the features of our new premium screener for basic users through October 20th. And this includes equations for more complex screening, including screening. It includes access to historical periods, and it also includes our quant facility. So equations allow you to write more complicated screening expressions. Access to historical periods allows you to look at, compare any metric versus itself or other metrics in past periods, both quarterly and yearly, up to 10 years back. And the quant facility will rank what passes the screener after you do the screening, so you can focus on the top stocks that pass the screener. For you screening fans, there's going to be a webinar that will do an in-depth dive on screening on Thursday, October 2nd at noon Eastern. That will cover screening in depth, and I'd highly recommend it. Screening is a great way to find new investment candidates. So with that, let's dive into the modeling facility. So portfolio modeling, what's the basic concepts? The basic idea of portfolio modeling is to use an existing portfolio as the baseline and then create a new model portfolio that results from a series of planned trades in the existing portfolio. The new portfolio model can be compared to the existing portfolio to see if it meets your investment objectives across a number of criteria such as potential return, risk, sector balance, etc. If it doesn't, the model can then be tweaked by adjusting your trades until the new model portfolio looks good according to the criteria that you care about. Once the model is complete, you then have a simple trade list that you can execute at your brokerage house, confident that executing the set of trades in the list will result in a portfolio that is designed to meet your investment objectives. The trade list also helps prevent errors that occur from seat-of-the-pants investment decisions that are made while your brokerage trade window is open. And believe me, it's a phenomenon with which I'm well acquainted with in my pre-Stock Rover days. So some of the things we measure in portfolio monitoring are the cash level, how much the trades are going to impact your cash, whether you're going to generate or consume cash by your trades. We look at the sector balance, the maximum drawdown in a defined period that both the existing portfolio and the model portfolio would have, so you can compare that. We look at the return and the risk-adjusted return versus the S&P 500 for both the existing and model portfolio, correlation with the S&P 500 beta and volatility, the Sharpe ratio, which is a somewhat arcane measurement of performance that I'll cover, and the price to earnings, price to book, and earnings growth of the existing and model portfolios. And lastly, the dividend payments and dividend yield. I know I went through that pretty quickly, but I'm going to circle back and cover all that in depth as in part of the presentation. So the best way to understand portfolio modeling is to see it in action. So we're going to go, we've woken the tool up, but let me just wake it up again so I can see the way of invoking it. So if you're in your main window, you can pick any of your portfolios and right-click on them, and you'll get the model option, and you click on it, and that'll open the model window. So the first thing we're going to do is take a tour of the modeling window so you can see all the features of it, and then we'll walk through some sample portfolios that will give you an idea of how we might use it to plan some trades. So let's take a tour. In the upper left is the portfolio selector. So once this window is up, you can pick any of your portfolios here. So I'll start with Microsoft versus Google, which will be kind of the first sample portfolio we'll work with. One thing you can do is you, by default, highlight trade changes is checked. When you're making a change to a quantity, if it goes green, it means you're increasing your position, and if it goes red, you're decreasing your position. And in this model, we're leaving Disney, Visa, WellPoint, and Honeywell alone, but we're increasing Google from 0 to 42 shares, and we're dumping all of Microsoft. We own 535 shares of it. We're going to sell it all. And the model cost of doing that is actually negative $57, which means this, at current prices, this will actually generate $57 of cash. This, if you turn this off, you just lose the coloring. So everything else is the same except you don't get the changes highlighted. I like to keep it on, and I'll keep it on for this webinar. If we go over to the right, you can print your model. You get this nice display, and if you go to print it, it will show up. You can either save it as a PDF or put it out to a printer, and you get a nice display of your model. So that's a nice feature. If you want to work with it in Excel, you can export it, and an Excel version of it will be exported. Up here, as I mentioned, is the ability to detach the portfolio. This is how you get help on modeling. If you click here, that'll open up a new window that'll give you help on modeling. And if we go back here, if you want to close the facility, you just click that X. Now, the modeling is divided into two panels, which is the table window and the analytics. The analytics window can be closed or minimized by clicking these arrows, and clicking these back will bring it back. So I'm going to minimize it for this part because I want to talk about this part of the modeling facility. So basically, one of the things you'd want to do in a model typically, and what I'm going to do actually a couple of things. This is grouped by sector, but I'm going to disable that by just go back grouping by none. And I'm also going to reset the model just so it's back, there's no trades in it. And I'll come back to that in a second, but I want to start kind of clean. So this is showing kind of this portfolio, the current quantity and the model quantity. There's no changes to it. So as you go, you can see it's a classic Stock Rover display with all the columns. And you can rearrange the columns. You can drag them and change your position. If you don't want to see them all, you could basically get rid of a column if you don't want a column. But these are all the columns displayed in their default order. When you want to basically add a new stock to your portfolio, you click on the Add Ticker button here, and that'll open up a row here, and I'll put Google back in, put our 42 shares back in, 43, change that back to 42. And changing a model quantity is simple as clicking on the cell here and just changing the quantity. Another way to add a ticker is just right-click on any stock and just click Add New Ticker. And for example, if you wanted to add Apple, add 100 shares of it, that would get added in as well. So those are two ways to add tickers. To change quantities, you just click in any of the cells and just type the new quantity in. To remove something, you can right-click on it and just say Remove. Now, if it's not currently owned in the portfolio, which Apple isn't, that'll remove it. But if it is something we do own, such as Microsoft, we own currently 535 shares of it. If we wanted to sell it, which we are going to do for this portfolio, we can't actually remove it because it has to stay in the actual portfolio, but we can set the quantity to 0 in the model portfolio, and we do that just by clicking here. We could also obviously just type 0 into the cell. And as you've already seen, if you've made a bunch of changes and you're just not happy with it, you can get back to ground zero just by hitting Reset Portfolio, which would reset it, get rid of all the changes. We don't want to do that because this is actually where we want to be. So basically, we should have the current price, the current quantity, the model quantity, the value of the current quantity and the model quantity, and the percentage of the portfolio each is, and then the trade that will accrue. We're going to buy 42 shares of Google and sell 535 shares of Microsoft, and that's going to cost $24,000 plus dollars to do. It'll generate $24,000 plus dollars of cash when we sell this, and the net is that we're going to gain $52 of cash at current prices. So that's kind of a spreadsheet to show you the changes as you work on your model, what the impact is on the holdings and on the cash. So that's the left side, and now I'm going to bring back the right side because that has the analytics. And the analytics they involve comparing the current actual portfolio to the model portfolio. I'm just going to pause here for a sip of water. Okay, great. So there's three sub-panels in the analytics section. There's some historical data, which I'll cover, some current metric data, and then there's the sector distribution. So let's go one by one. So the first thing is in the historical data, we can pick any period we want, and I'll talk about what that means in a second. But basically, we can pick anywhere from 5 days to 10 years, or these kind of convenient selectors year to date, last year. We can also pick any custom date to consider by just putting in the actual dates we want. Now, what that's doing is basically constructing the model portfolio as if you owned the new stocks at the beginning of the period rather than the current stock. So you can see what the historical performance would have been. There's no guarantee that the future performance will match that, but it does give you an idea of how the performance changed over different periods with your proposed trades versus the actual. So, for example, if we look at 1 year, 3 months period, Microsoft's been doing very well lately. We see that if we were to own Google rather than Microsoft 3 months ago, it actually would have had a negative impact in that period of 1.9% on the portfolio. I'm going to walk through all these analytics, but I want to point out that to get information on what each one is, you can just click this I button here, and that'll open up a new window, a help window that will cover what each analytic means. So if you forget what it is or the exact details of it, that's an easy way to figure out exactly what's meant by it. So let's walk through the analytics. The historical return is basically comparing the two portfolios, how they've done with dividends included over whatever period of time you select. So if we look at a 1 year period, we'll see some different results. The actual portfolio was up 30% in that period, and the model was up just under 28. The next statistic is the max drawdown. That's the percentage difference between the maximum peak to trough decline during the reporting period. And what it means is really that's the worst case capital destruction that occurred in the period. And what we see is that the worst period in 1 year that the actual portfolio had was a decline of 5.3%. There was a bigger decline in the model portfolio of 7.5%, and that's due to the fact that Google is more volatile than Microsoft, and as a result, there's more price action. The next one is return versus the S&P 500, and you can see both portfolios in the 1 year period have outperformed the S&P 500. The next one is the risk-adjusted return versus the S&P 500, and if I widen this out, you'll see the full column name. I'll make that a little that way. And what that means is taking into account the volatility of your portfolio versus the volatility of the S&P 500, what was the return, and you can see that this portfolio probably is a bit more volatile than the S&P 500. So the risk-adjusted returns were lower than the actual returns because this portfolio is taking more risk than the S&P 500 to achieve its returns. The correlation with the S&P 500, both of these portfolios both are large cap S&P 100, so it's no surprise that the correlation is almost 1, which means they move pretty much exactly like the S&P 500. They have slightly more beta, and what beta is the expected change in price of the portfolio relative to the change in price of the market. So if the market goes up $1, you'd expect your portfolio on average to go up $1.07 for the actual, and $1.18 for the model, and that's the same thing in the other direction. So it's another measure of kind of the price action of the portfolio, and both of these will, on a typical day, move more than the S&P 500. Volatility is similar to beta, but it's really a measure of how much. It doesn't involve a comparison with the market. It's just a measure of price change, and it's computed as the standard deviation of the daily percentage price change in the selected time period. And the bigger the number, the more volatile the portfolio is. And what this means is that a portfolio with Google in it versus Microsoft would show more price variation on a daily basis by a bit. And the Sharpe ratio is a measure of risk-adjusted performance, and it helps you see whether returns are due to smart investment or just taking excessive risk. The higher the Sharpe ratio, the better the risk-adjusted performance. It's a metric that was developed by Nobel laureate William F. Sharpe, and it's calculated by subtracting the risk-free rate of return from the portfolio's rate of return, where the risk-free is defined as the rate paid by the 10-year Treasury, and then it's dividing that result by the standard deviation of the portfolio return. So it's a bit complex, and the number itself doesn't mean much, except the bigger the number, the better. So when you're comparing two things, you definitely want to see a higher number. You can see in the 1 year period, the Microsoft portfolio has outperformed the Google portfolio, according to the Sharpe ratio. The next section really covers the metrics, current metrics, the current PE of the portfolio, and we can see by dumping Microsoft and adding Google, Google has a higher PE than Microsoft. It trades at a higher valuation, and we can see the PE of the portfolio has gotten higher. But the earnings, Google's expected to have higher earnings growth than Microsoft, and As a result, the earnings growth this year is expected to be higher, as well as the earnings growth next year. So we've traded valuation for some growth. The price to book is pretty much, in price to sales are the same in the two portfolios. And notice we're losing quite a bit of dividends. The actual portfolio of Microsoft will generate a little over $1,800 in dividends, or a yield of 1.6, whereas with Google, we're losing. If Google doesn't pay dividends, we're losing Microsoft's dividend, and that drops. We lose $700, almost $700 of dividends, and yield drops to 1%. And then this last section shows the sector balance, and because we're just trading tech for tech, you'll see there's no change there. I'm going to do another example that works with the sectors a bit later in the presentation. So that's kind of a tour of the analytics side of the whole model piece. And now what I want to do is kind of work through a few portfolios to show it in action. So let me pause for a sip of water. Okay, so the Google portfolio, this Microsoft versus Google, all the portfolios I'm going to show are constructed the same way, that they were created with equal weight allocations on the beginning of the year, January 1st. And in this portfolio, I started with 5 large caps and 5 sectors with 20,000 in each sector, each name at the beginning of the year, for $100,000 in the overall portfolio at the beginning of the year. So what we're thinking about doing here 9 months later is swapping Microsoft for Google. And the reason we're doing that is that Microsoft's had a great year. They got a new CEO in March, February, I believe, February, March, and since then the stock has done very, very well. The new CEO has done a number of initiatives that have made appear to be helping Microsoft, and certainly have made stockholders happy. And as a result, Microsoft has outperformed Google. But the bet here is that that halo is going to wear off, and that it's going to get back to results. And on results, Google's been the stronger, faster growing company over the last number of years, and we're kind of betting that the halo is kind of near the end of its life and going back to Google, which is why we're contemplating this trade. And I want to emphasize, this is just a theoretical trade for the example. I'm not making a recommendation of one company or the other. So with that said, how do we evaluate this? Well, we've already looked at these metrics, but let's look at kind of how this trade plays out. If we look at 3 months, if we did this trade 3 months ago, we'd see it would be a losing trade that Google's underperformed. And if we go out 6 months, it's underperformed even more. The actual has beaten the model. If we go out a year, we get similar underperformance. So basically, Microsoft's had a better year than Google. Well, if we start looking at longer periods, like 2 years, we see that now the difference is really narrowed. Basically, the historical performance is almost the same. The risk adjusted is still better in the Microsoft because there's less risk with it. But if we go to even a longer period, such as 5 years, then we see Google's outperformance of Microsoft. So what we're betting on with this trade would be that this longer-term trend is going to resume, and that we're going to get outperformance in the long term by making the trade. But the point is that the modeling facility helps you understand kind of what has happened. There's no guarantee that that's what will happen, but it does give you some signposts about how the portfolios have performed under the 2 different scenarios. So that's Microsoft versus Google. And what I'd like to do now is to switch to a second example, which is sector balance. When we bring this portfolio up, it looks like kind of a mess. There's actually in this portfolio, this is another portfolio created at the beginning of the year with 125K of funny money, virtual money, put in 8 stocks across 4 sectors, and each sector had 2 stocks in it. So the portfolio as a total had $1 million in it at the beginning. And the goal is to maintain that balance in the 4 sectors. So what we're saying is we like all 8 companies the same, in that in the last 9 months, some have outperformed and some have underperformed, but we want to get back to balancing. And I think you'll see more clearly what's going on if I group this by sector. And now you see we have 4 sectors: communication services, which is telecom, consumer cyclical, which is discretionary, also called discretionary, healthcare, and tech. Each one has two names, and we want to get this back so that each sector has 25% and each name has half of that at 12.5%. Now, rebalancing for an individual investor, I wouldn't recommend doing it. I would recommend doing it after a year has elapsed, because that means you're going to probably be selling things that have gains, and you'll be paying taxes, and you certainly want to have a holding period of at least a year so that any gains you take would be taxed at the lower long-term rates rather than the higher short-term rates. So in general, I'd say rebalancing, allow at least a year to go by before you rebalance if you're an individual investor. So with that said, let's see how we get this portfolio back in balance. So if we look at where we're currently at with the portfolio, we see that we go right to this third section here, which is the sector balance, and we see the telecom has underperformed and has dropped to just 21.8% of the portfolio. Consumer cyclical and healthcare have outperformed, and they're now bigger than 25% of the portfolio. And tech is underperformed by a bit. What we want to do is get these all back to 25%, and the modeling facility helps us do that. And the way we do that is we look at each stock and we try to get it back to its 12.5% weighting, and we execute the trades that will get us there. So we can see that both Comcast and Verizon have underperformed in this portfolio, so we actually are going to make the leap and buy more of them. And to get them back to balance, we have to buy 325 shares of Comcast and 416 shares of Verizon. Hanes brand in our consumer cyclical area has been an outperform. It's done very well, and we actually have to cut back on it. We have to sell 391 shares of it to get it back from its current 16% allocation to 12.5. And Nike, similarly, even though discretionary outperformed was as a sector, Nike actually underperformed, and we have to increase our holdings by 250 to get that to its balance point. And similarly, trades ABC, AmerisourceBergen, and healthcare has underperformed. Gilead's outperformed, so we're selling some of that and buying some of that to get us to our balance. And here we see the price change. Gilead's at 12.4. So if we go a little bigger, let's just say we go 1362, just add shares, we can just knock that up to 12.5. So it's that easy to kind of get things in balance. And then Google has underperformed, as we saw from the last screen. We have to add 28 shares of that, and we've owned Harman International, and we have to sell 99 shares. So this gives us the recipe, our kind of trade list, to get this four-sector balanced portfolio back in balance. Typically, because these stocks are bought at the beginning of the year, we wouldn't want to do this trade until next year, but for purposes of the webinar, I just wanted to show an example of doing that. Okay, the next portfolio I want to show is Big Dog Growth. And this portfolio is 5 large cap stocks in 3 sectors. And again, $20,000 was put into each stock at the beginning of the year for $100K in the portfolio. We basically like the portfolio, but we're thinking of making some changes to better names. In consumer cyclical, we own 3 names. We own 2 names, Amazon and Priceline. And we're thinking of dumping Amazon and replacing it with Under Armour because we're concerned about Amazon's valuation and perhaps their lack of long-term profitability. So we've decided we want to go with Under Armour, and we're going to test that trade out in the modeling facility. In healthcare, we've owned Biogen, but we've become enamored of Gilead, so we want to basically dump our Biogen and go to Gilead. And in tech, we've owned Baidu and Qualcomm, and we want to basically make a big bet on Google because we think it's coming back. So again, these aren't personal recommendations. This is just for examples of the modeling facility. So that's kind of our trading plan, and we want to take a look at whether this is kind of a good idea or not. So we start with the sector stuff, and I've done it in a way so that we're leaving our sector balances the same. We're just changing stocks within the sector. So this is all kind of, we can see we're in the same ballpark, and the actual trades will generate $292 of cash at the current, consume $292 of cash at the current prices. But what I'm interested in is this panel. which shows that by doing these trades, we're actually going to decrease slightly the PE of our portfolio, and we're going to increase this year's earnings growth, but next year's projected growth is slightly lower. The price to book gets a little cheaper, price to sales gets a little more expensive, and we're losing our dividends. Qualcomm pays a dividend, it's the only dividend payer here. We're going to drop that, so having a no dividend portfolio. So those are kind of the impact of the portfolio. But what really gets interesting, I think, is looking at the analytics of how these trades have performed in the past to get an idea of whether these will likely perform better in the future. So if we look 1 year in the past, we see that if we had owned the stocks in the model portfolio, we would have done considerably better than the stocks we've held in the actual portfolio. So in that period of time, 18% outperformance and risk-adjusted outperformance of 9%, basically. If we go out to a wider period, say 2 years, let's see how that changes. So in 2 years, those numbers even get bigger. And if we go out even longer, if we go out 5 years, those numbers actually get negative. So that's interesting. So historically, over 5 years to 2 years ago, the current portfolio is a lot better, but then in the last 2 years, the proposed model portfolio has been better. So we're basically betting things that are going to turn. So that would be an indication that maybe we're kind of on the right side of momentum with this portfolio. Well, obviously, to do trades like this, you'd be doing a lot more research in each of the companies. But the facility is showing you kind of the analytics, how things have compare under the two portfolios. One more portfolio I want to show is kind of interesting is GARP, which is growth at a reasonable price versus value. And this portfolio contains 6 stocks in it currently that are basically what we call growth stocks. So these are like 6 stocks in 6 sectors: Comcast, Disney, CVS, Gilead, and Boeing. And these stocks are all stocks that are the best, kind of the best GARP stocks in their sector in the S&P 100. And that's determined by having the lowest PEG ratio, which is price to earnings ratio over the expected growth. And with growth as the denominator and P as the numerator, the lower that number, the better. And these 6 stocks have the lowest PEG in their sector for the S&P 100s. So we've basically said, well, this has been a growth portfolio, and but we're starting to feel that maybe the market's shifting a bit to value, and we want to change to equivalent stocks in their sectors that are the cheapest stocks by value. And for that measure, we're going to use enterprise value over EBITDA, which is similar to price to earnings, but I actually prefer it because it normalizes the debt structure. So if a company has a lot of cash or a lot of debt, that's normalized out by the enterprise value over EBITDA computation. So it's a better apples-to-apples comparison. And the 6 stocks here, AT&T, McDonald's, Walmart, UNH, Raytheon, and Hewlett-Packard, are the cheapest stocks by enterprise value over EBITDA in those 6 sectors of the S&P 100. So these is a radically different kind of portfolio. We're changing GARP for value. We're selling all our GARP, all our Comcast, for example, and putting it all into AT&T, selling all of Disney and putting it all into McDonald's, et cetera, under the bet that value is going to be better than growth in the future. And it's interesting to look at how the analytics change for these 2 radically different portfolios. So if we go down here, first of all, if we look at the sector balances, we see that that's been kept pretty much the same. But if we look at here, we see we've dropped the PE of the portfolio by quite a bit, from 20 to about 14.5. But the earnings growth has this year has come down quite a bit. This portfolio is expected not to grow as much, and the earnings growth next year is down quite a bit as well. Price to book has gotten cheaper. Price to sales has gotten cheaper. Dividends have gone way up from 1.3 to 2.8%. So kind of what you'd expect going from growth to value. But where it gets really interesting is when you look at the analytics. So if we look at a 5-year period, we see that value has been crushed by growth, that the growth portfolio, the actual, has performed much better than the model portfolio. The model portfolio has less volatility and less beta, but has underperformed dramatically in return. So even the risk-adjusted return is quite a bit under. But if we start going to shorter periods, we can see still there's underperformance in 2 years. It's still been a growth market, and in 1 year, there's still significant underperformance. But if we go to 3 months, it's still underperforming. Or if we go to 1 month, it flips. We start to see that value in the last month has outperformed growth. And the bet is that we're at kind of an inflection point, and that's going to change. And if you were an investor thinking about switching from growth to value, this would be kind of indicative in the fact in the last month value is starting to gain on growth. And this is an example of how your portfolio would change if you were to make these trades. And there's one last portfolio I want to show you before we get to the questions, which is dividend stocks. And here we have 5 stocks that we own across 5 sectors, again from the S&P 100. And the stocks that we own are in red because we're going to be selling them. And these stocks here are the highest yielders in their sectors. For example, AT&T is the highest yielder in telecom. McDonald's is the highest yielder in consumer cyclical. Philip Morris in defensive or staples, ConocoPhillips in energy, and GE in industrials. And we're going to trade these 5 stocks. As you can see, we're selling all of them. We're going to trade them for a like amount of a stock in the same sector that has the highest 5-year dividend growth. So we're going to basically trade current yield for dividend growth. And those stocks would be Comcast, Starbucks, CVS, National Oil, Varco, and Union Pacific. Excuse me. And so what we're interested in is how does this change, switching from a dividend yield portfolio to a dividend growth portfolio, what happens? Well, again, the sector stuff stays the same. But what's interesting is that going from yielding to growth, the PE of the portfolio has gone up quite a bit. And the earnings growth this year actually is much higher in the yield versus the growth. And that's probably due to a couple of write-off income statements. I haven't looked at the financials of the companies, but somebody clearly had a big write-off in the growers. But if we look out the expected earnings next year, we see that the dividend growers are expected to grow much faster than the yielders. Price to book is roughly the same in the 2 portfolios. Price to sales is actually a little cheaper in the growers versus the yielders. But here's the big change. The dividends, if we have the current portfolio, which is the yielding one, is over $4,000 of dividends, and that drops to $1,700 per year when we go to the grower. So we're dropping our yield from 4.2 to 1.8. So if we're going to lose that kind of yield, there has to be a good reason for it. So if we look at kind of how these portfolios have performed, in the 1 month, the yield has done better than growth. But if we start looking at wider periods, well, let's look at 6 months. We'll see that the model portfolio, which is the growers, has outperformed the yielders by 3.3% and actually has better max drawdown, less max drawdown, which is good. And it has its risk-adjusted returns exceed as well. They both correlate highly with the S&P 500. There's definitely more volatility in the growers versus the yielders, so you are going to get more price action, price volatility with the new portfolio. But you are getting more return in this period. But if we start going out to different periods, if we go 1 year, we see this number gets bigger. And if we go to 2 years, we see even a bigger number. And if we go 5 years, still a bigger number. And if we go out 10 years, bigger still. So every period we've looked at, the dividend growers has outperformed the dividend yielders. So this is a portfolio we might want to switch to if we can suffer the loss of the actual dividend stream. So that's an example of how you would use modeling to help plan your trades and see what the impact is on the portfolio. This all presupposes that you've done your research on these companies and you want to buy them for other fundamental reasons, the companies you want to add. So to summarize, the portfolio modeling facility is really quite powerful as a trading partner. You can plan, test your plan, tweak your plan before you execute any orders. And then the actual execution of trades is just a mechanical process with no emotion. And it's a much safer and smarter way to invest, I believe. And we hope you've enjoyed this webinar, and as a result, we'll take a look at portfolio modeling and see for yourself what the facility can do in the way of helping you in your own investment planning efforts. And with that, I thank you for taking the time to join us today, and let's go to the questions.
Okay, hello. I'll help you with the questions. Yeah. My name is Alex Reisman, and so, all right, we have a few questions that have come in. The first one is just to actually comment on our alerts facility. One of our beta testers is finding it to be working nicely, so that's good to hear. And alerts are coming to all premium users pretty soon. The next question is, what is the source of the future growth estimate?
Yeah, that's a good question. The source of future growth estimates are kind of the average of all the analysts that follow a given company. So each analyst that follows a company will have its estimates. So let me close up this and show you exactly where it comes from. So if I bring out the Insight panel, a company like Microsoft, if we go to Insight, the Insight panel, the main product, the detail, we see that there are 20 analysts following Microsoft, and we take the average EPS estimate for next year and compare that to the current year, and that's where how we compute what the growth is, basically.
Great. Do the analytics take into consideration dividends in the return calculations?
They do, and that's actually one of the nice things is that obviously stocks that are paying dividend, you expect significant dividends, you would expect less price appreciation than stocks that aren't. So the dividends are added back in to the calculation, so you're comparing apples to apples.
Next question is, when you see a tip in growth and value, like you mentioned when it started to change with 1 month out, what other indicators do you look for to see if the market may be changing?
That's a great question. Typically what I would do, and I don't remember offhand the ETFs that would map it, but I would typically pick a value ETF and a growth ETF, and I'd map them against each other in the chart, and I would flatline one of them. If we pretend these are growth and value, I would look to see over periods of time whether the charts appear to be crossing. This is, for example, a Microsoft Google chart, so it's not really the same thing, but the idea is that you look at the chart of growth versus value, and I'd use the growth and value ETFs, and I don't have them off the top of my head, but you could look them up. Actually, you could find them in Stock Rover. If you go to ETFs, if you go to domestic diversify, you could find a large growth one. Let's find a big one, basically. Actually, I think I'll skip this, but basically, you find your growth and value ETF and compare them against each other and see how the chart is going, basically.
Great. I haven't heard the term attribution analysis. Did I miss that? Is there a way to do that within sectors, industry groups?
That's a really good question. I didn't hear the term because I don't think I used it. Attribution analysis is something looking at kind of as we evolve the Stock Rover tool to get a better idea as to kind of where performance is coming from. But no, that's is there a way to do that within sector industry groups? I want to think about that and take that offline and think about that. Off the top of my head, there's no simple way to do it.
Is there any new progress on having the brokerage houses send our quarterly statements to Stock Rover in order to incorporate the dividend reinvestments accurately?
Yeah, that's a good question. Brokerage house is clearly something we want to get to, and that's for us is really a two-part development effort. Part one is switching our portfolio facility to be able to handle transactions, and we've made quite a bit of progress with that. We've actually got a development team working on that. It's a complex project, but it's been going for a while, and we're hoping in the not-too-distant future to be able to basically be able to export a transaction stream from your brokerage house, import it, so it'll be much simpler to maintain your portfolios and get it right. And then once that's done, the next step would be to automate that. So it's kind of a two-step process. So it's still probably a number of months out, but we are working on it.
There's two questions I'm going to roll into one here. What are some signs in the analytics that might cause you to change your mind about a trade, and how do you decide which time period to use for the analytics?
I'll take the second question first because that's a bit easier. The time frame I'd use for the analytics are kind of the same as the time frame I'm thinking about for an investment. So for example, when I was doing the Google versus Microsoft comparison, I would look at that as a long-term trade. It's basically selling Microsoft, buying Google, and holding it for a long period of time. So when I do that, I'd be looking at longer period analytics for that. If I'm thinking in terms of a short-term trade, I would definitely be looking at kind of, there is a phenomenon known as momentum, which persists, so I would be looking at shorter periods like 1 month, 3 months, 6 months, and assume that those trends are going to continue for a while and trade on that. I would not look at long-term trends. And the first part was, analytics that would cause me to change your mind about a trade. Well, for example, if I was looking at Microsoft versus Google, and I looked over a number of periods, and in almost every period, it turned out to be a bad trading idea, I would rethink whether I really had gotten it right about that trade. So I think when the analytics don't support what I want to do, I would be thinking twice about it. For example, in the value example I gave, it's only in the last month that value has outperformed growth. I would actually want to see a longer period of outperformance before I would commit to a value strategy over growth.
Mm-hmm. After looking at a portfolio model, what are the next steps? Is this the last step in the process before making trades, or do you run additional processes on your stock picks afterward?
That's another very good question. Typically, this would be towards the end of the process. Typically, the names that you have that you're either reducing or eliminating your portfolio, and the names you're adding are a function of doing fundamental research on the company such that you believe that your trades are actually smart trades. And then when you get to the modeling facility, you're playing with quantities and allocations to see how the analytics change, and you're validating kind of what the performance and expected performance might be based on the trades. And those might cause you to tweak the amounts or quantities, but you should at this point already have a pretty good idea of what you want to increase and what you want to decrease on a relative basis.
Mm-hmm. So just a nice comment, excellent tool, constantly improving. Really like the notes ahead of time, allows me to pay better attention to the presenter. So thank you for that.
Glad to hear that. That's good feedback.
And then this is the final question we have right now. What are the most representative growth and value indices?
Oh, that's a good question. I think the ETFs, and honestly, off the top of my head, they'd be like the I set, the Barclays set, which are the most traded. I think actually, let's find them. So what we want to do is go to, we want to find, I think if we go to profile, I need something with volume in it because I got to find the things that are traded a lot. Okay. And then if we go to, if we have large growth, for example, and if we trade on volume, we're going to find the biggest ETF, which would be, for growth, would be actually the Russell one. You could pick the Russell 1000 or the S&P 500. So you'd have to pick which growth kind of proxy you want to use, but you pick one of these. And if you want to go to value, you could go to large cap value, you could go to mid cap value. But if we pick large cap value and we sort by volume, we see that the two big ones are the Dow Jones, and this was the Russell 1000, which is a broader based index that I would probably use. So I think there's growth in, there's growth in value indices in the large cap, mid cap, and small cap. And if you really wanted to do a blend, you would basically create a portfolio that had a third of each, say you'd have one-third large cap value, one-third mid cap value, one-third small cap value for one side of it, and then the same thing on the growth side. I did a webinar a while ago where I showed how to build a portfolio that had that kind of construction. But that's what I would use. That way, there wouldn't be any bias to cap size. You'd be strictly segregating by value and growth.
Okay, great. So that's the last question, and I'll get offline here.
Great. Well, again, I want to thank everybody for attending, and I hope you found it useful. And I would encourage you to just try out the portfolio modeling and play with it and see if it can be of value in your own investing path. And with that, I wish everybody a good afternoon, and thank you all again for attending.